Joining us this morning is Ruchir Sharma, Rockefeller International Chairman, for his outlook. Ruchir, it's great to have you back. I wonder what you make of this strong and steady resilience after that brief, mild decline on Friday.
Well, I think the markets over time have learned to brush aside geopolitical tensions. In fact, we've done some research on this. And what it shows is this, Carl, that if you look at since 1950, the 25 most significant geopolitical shocks around the world, the S&P 500 tends to decline by about 4% within 15 days. And within a month or so, tends to recover that 4% loss completely. That's because in 9 out of 10 times, the geopolitical tension tends to be contained and doesn't spread. Now, the markets have become even wiser over time that these dips on geopolitical tension have gotten shallower and shallower. So I think that's what we're seeing here, which is that the markets think that, this appears like a scary moment, but in its collective mind, it looks back at history, says 9 out of 10 times the geopolitical tensions tend to be contained, and so carries on. Now, there's obviously a risk that there'll always be that 1 out of 10 times, and that's the fear that lives in most individuals' minds. But as I said, that history is better remembered than it's lived, and that 9 out of 10 times, these things just tend to fade. And like in the past, too, we think that this is a very uncertain time, but in the past, there's always been uncertainty that tends to get resolved the right way.
Meantime, I wonder what you make of what some call a gradually slowing economy, one that may continue to slow into the back half. Do you think that creates a backdrop where you can sort of defend against geopolitical risks that pop up or trade disputes that pop up?
Yeah, I think that there's no doubt that the U.S. market's resilience in the face of all that's happened this year is quite stark and quite surprising to many people. But I think that the biggest story, Carl, this year has been just how well international markets have been doing. And the dollar's been a very big factor out there. So I think that what we're seeing this year is that flows have begun to the international markets again after a long drought. That's the real story. In the U.S., the big story remains just how smart the retail investor has been. We always tend to sort of look at the retail investor as dumb money, as the laggards. But something which I've also now come to sort of appreciate is that the retail guys have really ended up being smarter than the hedge funds because they're the ones who bought in size and in dip when this market sort of went down a lot. And it's the hedge funds who are now sort of nibbling in every time that there's a dip because they are lagging behind the benchmarks so significantly. But the big story here is that the American economy so far has been relatively resilient, more resilient than most of us would have expected.
So on the outperformance of particularly Europe, like a stock market like the German DAX, I mean, the biggest reason I hear for it when we talk to investors is it's just underperformed for so long. And it was due for catch-up and that everyone was too negative. Is there any fundamental reason to continue to shift money into Europe from the United States?
Well, I think that, this is happening across the world, and it's not just Europe. I mean, that if you look at what's happened to emerging markets as well, they're also up double digits this year in dollar terms. So, yeah, in many ways, this is a catch-up trade, where the U.S. market had run away far too much, had come to dominate too much. But also there has been some fundamental change. You spoke about Germany. I think a story that has faded now, but was a big story a couple of months ago, is that they are carrying out more economic reforms. They are putting more stimulus to work. They are spending more on defense. And similarly, many other countries around the world have been reacting to the tariffs and other headwinds that are coming their way by stimulating more, by cutting interest rates, and also by enacting more economic reforms. So there is a fundamental story, and it's not just about Europe. Stocks in Latin America, in fact, have been the best performing stocks in the world this year. That region has done really well from Brazil to other places because you have more politically friendly leaders coming to power or leading in the polls as it has big elections this year. So this is a universal pattern. The most important driver of this has been the dollar and the fact that too much capital had become concentrated in the U.S., and that is finally beginning to diversify after 15 years of heading one way, which is all into the U.S.
Right. Next time, we'll talk about your recent piece regarding Chinese consumption. Really interesting picture going on over there. But for now, Ruchir, thanks for your time. Good to see you.